If you're a stock market investor, chances are your portfolio has been off to quite a rocky start in 2022. And with the market still hovering well into negative territory as of the making of this video, it's left many investors wondering what they can do to improve their portfolios and turn things around for the better. I'm Jarrett McKenzie, Managing Associate at Henssler Financial, back with you for another edition of Planning Priorities. Although economic and market conditions are making it difficult to find worthwhile opportunities, the losses that many investors have experienced in their IRAs have created a prime opportunity for a strategy known as a Roth conversion. Now, for those of you unfamiliar with this strategy, a Roth conversion is essentially the movement of assets from a tax-deferred account, such as an IRA, to a Roth IRA, which is considered tax-exempt, since the dollars we contribute to a Roth have already been taxed, and the growth of those accounts are free from taxation in the future as well. Now, that being the case, converting money from an IRA to a Roth IRA is a taxable event that will certainly increase your tax liability for the year. So you should consult with your tax advisor if you feel this strategy may be appropriate for you. Given the many advantages a Roth IRA provides, including tax-free growth of money, no required minimum distributions, and the ability to tap into your principal after 5 years, converting traditional IRA funds to a Roth can help you lower the required minimum distributions from your IRA in retirement, and can also be used as an estate planning tool to provide a tax-free inheritance for your heirs. Perhaps the best part is that Roth IRAs also provide investors with a bucket of tax-free funds in retirement. Unfortunately, contributions to a Roth are only available to those with modified gross income of less than $144,000 in 2022, which is for single filers, and under $214,000 for those that are married filing jointly. However, all investors are allowed to convert their traditional IRA assets to a Roth IRA regardless of their income. But keep in mind that you don't have to liquidate your account to make a conversion. Your investments can stay intact so that there's no risk of being out of the market. You can also pick from specific funds to move from the IRA to the Roth, choosing to move shares with the deepest losses for the year, especially if they're high-quality stocks that you expect will recover. Also, a Roth conversion is not an all-or-nothing decision. You can choose to convert only a portion of your account now and wait to see where the market continues to move. And should it continue to fall, you can always convert more later in the year. Now let's consider an example. Say your $500,000 IRA is now down to $435,000. Ordinary income tax would be due on the amount converted to a Roth, so you would pay less tax by converting a lower amount. And if you're married filing jointly and let's say in the 24% tax bracket, converting the entirety of that account can lower the value and potentially save you more than $15,000 in taxes. The best part is that the investments rebound shortly thereafter. All that growth becomes tax-free to you in retirement. Talk about a win-win. So before the market rebounds and this opportunity eludes you, consider the potential benefits and tax implications outlined in this video and make the most of this painful start to the year. Thanks for watching this edition of Planning Priorities. I'm Jarrett McKenzie.